Hi, everybody. I'm Matt Rosu, Dean of the Sigmund Weiss School of Business and Professor of Economics at Susquehanna University. I want to talk a little bit about three economic consequences of the student loan forgiveness plan. So in late August, Joe Biden announced that $10,000 in student loan debt would be forgiven for many borrowers. Now, this announcement was met by cheers by some, jeers by others. And there are certainly good debates to be had on the fairness and ethics of this policy and really of any government policy. But as an economist, I want to stay away from that and really focus on three economic consequences from this particular decision. The first consequence, the first thing we need to understand is that the money to pay for this debt relief must come from someone at some point. There are several options for where the money could come from. So one option you could imagine is the money for the student loan debt forgiveness that's essentially being paid to some right now is being paid for by others right now. So taxpayers are paying for it now, which would mean some taxpayers are benefiting and some taxpayers are subsidizing those particular citizens. Now, those negatively impacted would include those who didn't go to college, would include those who went to college but have more, make more than the income limit. So they have some debt, but they make more than the income limit, so they can't get any student loan forgiveness on this. Or those who had student loan debt, but already paid it off. Now, a second option, instead of having it paid off right now, could be added to the federal debt, meaning future generations are going to either be paying back this debt, or if the debt is just held onto the books, then future generations will be paying interest on that debt in perpetuity. A third option, the U.S. could increase the money supply, which causes higher inflation rates. And of course, it could actually be some combination of these three actions. So that's the first consequence. It's just understanding this needs to be paid back. The second consequence, given the current economic situation in the U.S., giving money away is not going to help the economy. So economists from both sides of the political aisle generally agree when unemployment rates are high, government actions such as tax cuts, cash stimulus payments, or government increases can help the economy. Now you can see differences among those on the right and the left onto how much for tax cuts versus government spending, of course. But generally the idea of if unemployment rates are high, those actions could help. But given an unemployment rate under 4%, there's not really much economy-wide benefit from stimulus payments. Further, when the unemployment rate is low, stimulus payments like these can actually cause inflation. And we've seen some evidence of this type of policy causing inflation quite recently. Is right now we have the highest inflation rate in 40 years. One reason is the increased government spending over the past 2 years. So this new proposed policy will likely exacerbate issues with inflation. From an economic policy point of view, this would be way more defensible if unemployment rates were higher. Third, this will have a long-run impact. There will be long-term consequences on economic behavior. Now, a rule taught in pretty much all principles of economics classes is that people respond to incentives. Somewhat of a common sense rule, but it's laid out there, right? In principles of economics, it's important to make sure that is grasped by students. Now, by waiving student debt now, what are the future possible incentives that people might respond to? Well, current students should realize that this type of decision could happen again, which means the rational decision for somebody might be to take out more debt, or if they aren't taking out student loan debt, to start taking out student loan debt. Those in high school may be on the same trajectory, thinking perhaps I should plan to take out debt. Those about to graduate who've accumulated debt maybe will not want to pay it back as quick, thinking this type of decision could happen in the future. But given an announcement like this, it should seem reasonable that the probability of the same thing happening in the future is now higher. Because that's higher, we would likely see people carry more debt and obtain more debt. That's problematic. Maintaining a large debt load is not an ideal way to build wealth, and this forgiveness program incentivizes people both to obtain more debt and not to pay back debts quickly. So overall, my take on this, based on these three consequences, is it's bad economic policy. It's a stimulus to the economy when unemployment rates are historically low, threatens higher inflation rates with an inflation rate above 8%. It adds to our debt, and it encourages future behavior that's harmful. Once again, my name's Matt Rosu, professor of economics at Susquehanna University and dean of the Sigmund Weiss School of Business. If you like this video, appreciate if you'd click like and subscribe. Would help others see this video in the future. And thank you. Look forward to seeing you in the next video.